Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the assigned homework problems from the Digital Study Guide for Chapter 9, the problems that are Group B. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. Right, so let's go to 47 here, and we are working on accounting for mortgages. So we have the following transactions, and it says complete the amortization schedule for the first 4 mortgage payments on the $180,000 mortgage note, assuming semi-annual payments of $13,077, round to the nearest dollar. Okay. And then it says record the journal entries for the 2014 transactions. And then it says prepare the long-term liability section of the balance sheet on December 31st, 2014. So I'm just going to use this blank space over here. I'm going to end up pausing the video, so I'll let you know when I pause it because I'm going to erase information, and then I'll continue on with whatever I need to do. All right, so number 1 says complete the amortization schedule. Right. Excuse me. You should already know how to do amortization, so I'm not going to cover that theory again. And we did one problem that was one exercise. Let me go back and take a quick look to see which one it was. Come on. I'm looking. It was, get my pen. Here we go. All right. So it was exercise 9-31B. Okay. So if you need to go back and watch that exercise in order to it's very similar, so you can go back and use that as also a reference. But again, in that exercise, I am kind of telling you that I'm not going to explain the theory again. All right, I'm just going to work the problem. So we're making payments of $13,077. So all of the rest of these here payments are going to be the same. Okay. Now we have a starting loan balance of $180,000 right here. Okay. And we're making a payment of $13,077. A portion of that is principal and a portion of that is interest. We have to calculate the interest first, right? Because we know that on January 1st, purchase a building costing $180,000, signed at 11%, a 30-year mortgage note payable for the same amount. So we know that the interest is 11%, and it is a 30-year mortgage, right? But notice that the payment is on June 30th because they're making 2 payments a year, right? 2 per year. So every 6 months they're making the payment. Well, to calculate our interest, right, we're going to take the previous loan balance of $180,000 and multiply it by 11%, and then multiply that by 6 months over 12. So 180,000 times 11% times 6 divided by 12 gives us an interest payment of $9,900. Okay, and we're rounding to the nearest dollar. So the interest is $9,900, and if we take the $9,900 from the payment, we end up with $3,177. So the principal is $3,177. Now that's going to reduce our loan balance, right, $180,000 less the $3,177 gives us a new loan balance of $176,823. Okay. So with that said, this here is $176,823. Now, when I had alluded to exercise 9-31B, we did the same exact thing here, but I didn't go through the entire table. Okay. Here we need to prepare the long-term liability section on the balance sheet for December 31st. So I'm going to do December 31st, but I'm not going to do the other. I'm not going to do June or December unless I absolutely have to, based upon the information above. Right? You'll be able to fill out the those particular payments because it's basically just the same exact thing. Okay. Right. So now we have a new loan balance. Okay. Our new loan balance is $176,823. Okay. And we're going to make the same payment here of the $13,077, and a portion of that's going to be principal and a portion is going to be interest. We're doing the same exact thing again and again and again. All right. So instead of $180,000, we have $176,823 times 11% times 6/12 because it's a 6-month period, and that's going to give us a new interest amount of $97.25. Right? So out of this $13,077, $9,725 is interest, which gives us the amount against principal is $33.52. Okay, so here we have $97.25 and then $33.52, and that reduces our principal amount, right, by the $33.52, which gives us a new principal amount of $173,471. $173,471. Okay, so I'm not going to, like I said, I'm not going to complete the rest of this table. You can do those additional calculations for yourself, right? So I'm going to pause the video here, and I'm going to erase all of this. Okay, so here I am, I'm erasing, and it says here, what do we need to do next? Okay, so next we need to record the journal entries, for the 2014 transactions. Okay, so on January 1st, on 1/1, we purchased a building costing $180,000 and signed an 11% 30-year mortgage, note payable for the same amount. So we're getting a building, and building is an asset, so we're going to debit building for the amount of $180,000. And we're taking on a note payable, which is liability, for $180,000, right? So that's January 1st. June 30th, made the first semi-annual payment on the mortgage payable. So on June 30th, we're going to make the mortgage payable, right? So we're going to make the payment on the mortgage, so we're going to credit our cash for the $13,077, and now we have to record the principal and interest. So we're going to debit the note payable because that's the principal amount, and we know that amount is this $3,177, and we're going to debit interest expense for the $9,900, and our debits equal our credits on that payment. Okay, so that's June 30th. Okay, now December 1st, signed a 5-year lease to rent a warehouse for $12,000 per month due at the end of each month. The lease is considered an operating lease. Okay. Well, there's nothing to do here, right? Because all we're doing is we're signing the lease to rent, right? But we haven't collected money, we haven't done anything else. It's only a signing of the document to enter into a contract, but no transaction has occurred. So for December 31st, there's no entry. I'm sorry, December 1st, yeah. Okay, not 31st, December 1st, no entry. Now, for December 31st, paid 1 month's rent on the warehouse. Okay, well, we're paying rent. Simple as that. I mean, you should know how to do that. We're going to credit cash, and that's in the amount of the $12,000 that was for the lease, and we're debiting rent expense for the $12,000. Right? So on December 31st also, we leased 10 copiers and signed a 4-year lease with the option to buy the copiers at the end of the 4th year at a bargain price. Under terms of the lease, monthly lease payments do not start until January 31st, 2016. The present value of the lease payments is $33,000. Okay. All right, so 12/31, right? We're leasing the copiers. Okay, so we're purchasing the copiers, right? And we're going to make a payment of $33,000, 4 years from now. So we're getting the equipment, right? That's an asset. This is a capital lease. It's not an operating lease. We're buying equipment. Even though the equipment is going to be used in the operation of the business, where it has, it's something that we're going to own, right? Because we have the option to buy the copiers at the end of the 4th year. If we didn't have that option to buy, then that would make it an operating lease. So go back and watch the theory videos if you don't understand the difference between a capital lease and the operating lease. Capital lease is when you're leasing to buy, just like you would lease a car to buy the car. But then you can have an operating lease where you don't actually own it. You're only leasing it to use it. And that would be an operating lease. Here we have the option to buy, so this is a capital lease. So we're going to own it, and therefore we're going to record it as an asset. So I'm going leased debit. We're going to debit leased equipment for the $33,000. And we're going to credit. Okay, so what are we going to credit? Well, lease payments don't start until January 31st, and it's for 4 years. So this is going to be a lease payable account, right, for $33,000, right, because it's something that we owe, right? That's why it's a payable, and it's on our lease. So as we make our lease payments, they're going to offset our lease payable account. So that's that entry. And then lastly here, it says made the second semi-annual payment on the mortgage note payable. Right, so on 12/31, we're making this here second semi-annual payment, right? So we're going to credit. That's very similar to this one here, right? Except we have, we're going to credit cash. It's going to be the same amount because we're always making that cash payment of $13,077, but our principal and our interest is going to be different, right? And it's going to be based upon whatever portion of that payment is. So we're going to debit note payable for $97.25, and we're going to debit interest expense for the, oops, wrong amount. Sorry about that. Got them switched. we're going to debit note payable for the $33.52 and debit the interest expense for the $97.25. Okay. Okay, so those are our journal entries, and now we have to, okay, so pause the video and copy all of this down because I'm going to erase it. Okay, here I'm erasing. Okay, erase, erase, erase. Okay, so now it says prepare the long-term liability section of the balance sheet on December 31st. Okay, so the structure of the balance sheet will have your heading liabilities, then you're going to have your current liabilities here, okay, and whatever your total current is. And then you're going to have long-term liabilities. And under the long-term liabilities, okay, what do we have? All right. We had the mortgage payable, okay. Now, actually, let me erase some of this. I'm going to abbreviate just because I need the space, okay? So I'm going to have my long-term liabilities here, okay? And then under long-term liabilities, I'm going to have mortgage payable. Now, if you look at the solution, it's showing a figure of $166,204, okay? And the notation for it was that on December 31st, it's represented by the balance at December 31st, 2015. The principal portion of 2015 payments of $35.36 plus $37.31, right, would reflect as current portion of the long-term debt and current liabilities at December 31st. Okay. Now, here's the thing. Okay. We're sitting here, timeline. Whoops. We're sitting here at December 31st, 2014, and this is December 31st, 2015. Okay. That's the current portion of that mortgage payable, right? 1 year, right? Remember that this mortgage payable is going out for 30 years here, right? But we have the current portion, and we're looking at whatever, we're looking at the current portion of that mortgage payable. So what's going to be over these next 12 months. And that's where you're having done these two calculations on this amortization table comes in, all right? If you had done the calculations and you had done them correctly, you would find that $35.36 would have been the principal on the June 30th, and $37.31 would have been the principal on December 31st. Now, that comes out to 7, 6, 12, 72.67, right? If we take the mortgage of $180,000, let me look at this just for one quick second. Okay, so we have this. This is the 72.67. All right, and our mortgage. Well, it started out at $180,000. Okay, and then our two payments of our principal on the two payments of $31.77 less the 3352 gave us a new principal amount of 173,471, right there. Okay, and that's as of December 31st. All right. So the book is kind of saying, okay, there's 160. The solution says there's 166,204. Well, how did we get at 166,204? Well, that should be your principal amount, okay, at the end of that period. If I take the 173,471 and we subtract out those two principal payments of 7,267, okay, that gives us 166,204. Okay, so they're kind of like just saying, okay, here's my long-term portion of the mortgage payable of 166,204. And while that's right, if you watched previous videos in the exercises or in the theory, you would have seen that I don't like doing it that way, okay? Because it doesn't give you all the information. So I'm going to show you, I'm going to do it the way I would like to see it, or the way most businesses see it, the way most accountants do it. Up in the current liability section, you're going to have your current portion of your mortgage payable, and that's going to show the $77,267. Okay, your mortgage payable would show the initial purchase of $180,000. I'm sorry, $173,000 because you made payments, right? So it would show $173,471 less the current portion of the mortgage payable, and that would be $72,67. So our $166,204 would still be shown here as the remaining principal balance of the mortgage payable. Okay. Doing it this way, you're breaking out the current portion of the mortgage payable, and you're showing it up here under the current liability section of the balance sheet, so that when you're doing financial analysis, you're using the correct number when you're looking at the balance sheet in order to do analysis for things like your current ratio, which is total liabilities over total assets, or your quick ratio, anything that's affected by your current liabilities there. All right, so yeah, breaking it out, I mean, they're asking you, what does the problem here is asking for the the long-term liabilities, and yeah, the balance in the liability account would be 166,204 after we've made the entries at the end of December 31st, 2015. But when we're sitting here on December 31st, 2014, this is the actual balance in the account, and then we're saying that we're taking out the current portion to arrive at that amount. All right, we're not creating a balance sheet that on 2014 that reflects a balance of 2015. Right. Okay, so and with that, also we have under the liability section, the long-term liability, we have our lease payable of $33,000, right, for the 10 leased copiers. Okay, so our total long-term liabilities are going to be $199,204. Okay, so that is kind of like how I would show the long-term portion of, that's how my balance sheet would look like. I'd have my current liabilities up here, and I have the current portion of the mortgage payable up here, and then my long-term liabilities would be here, and I'm going to, I'm doing the math to get the balance in the mortgage payable account, and the total long-term liabilities. I would not actually put the number here. I'd actually put it in this column, because in a column to the right, I just don't have the space, so that's why I wrote it here. But remember, whenever doing a mathematical calculation, we move one, doing multi-step formatting, we move one column to the left, do the math, and put the figure in the right. It's just like here, we do the math here, and we put the solution one column to the right. Okay, so with that said, that was a kind of a long problem, all right, and a long explanation, and I hope you understood it. If not, go back and rewatch the video, and watch it as many times as you need. Yeah, I didn't go through all of the math down here. Okay, doing this amortization schedule, you should have been able to do that for yourself, especially if you did exercise 9-31B. And if you don't understand some of this theory, you need to go back and pick it up, because as you can see, and it sounds like I feel like I'm always harping, but it is important. All right, you have to be able to read and see. I mean, this one said signed, no entry. This is a lease. Well, you have to think through what happens with a lease. Okay, you can't just this here was not in the book. It was not in the chapter. The concept is in the chapter, but the exact transaction is not in the chapter, and you need to be able to think it through. Okay, it's about understanding the concepts and applying it to the situation at hand. And so, if you don't understand the concepts, definitely feel free to telephone and speak with an instructor. That's what we're here to do, is to help you out with that understanding. Okay, so I'll see you in the next video.